Welcome to Home Buying 101 with Francisco Gonzalez. Today with me is James Serrano from Fairway. How are you doing today, James?
I'm doing great. How are you?
Good, James. So, James, thank you for being on the show, of course. But, James, tell us who you are, how you got in the industry, what do you do?
Yeah, so I've been in the industry now for just a little over 7 years. Prior to mortgage, I was in banking. Did that for, I think, about 7 years too. Did, consumer lending. My wife's really good friend was a real estate agent and knew I was looking to make a change into a mortgage. So she introduced me to one of my managers at that point and got me into the business, gave me an opportunity to learn without having any kind of experience. And then from there, just grew myself, grew my knowledge, and grew my business. And from there, just been trying to be the best I possibly can and grow myself and create as many relationships as possible, whether if it's with clients or agents, and just letting them know that I care about them as people and trying to build relationships.
That's awesome. That's awesome. Thank you for that. So, James, every week we start off with talking about what the market looks like this week. Active listings this week, we've got 11,775 active listings, which is down about 104 from last week. Coming soon, we've got 489 coming soon listings. Pending, we've got 9,069. We've got a median list price right now at 509,000 with a median sold price at 437. And days on market, we're looking at 75 days. So let me ask you, with the median sold price at 437, what does that look like on a monthly basis for our clients?
So it's going to vary whether you're looking at FHA or conventional. And of course, credit score is going to matter as well. But let's just say rates right now, we'll just say high 6%, looking at both. About FHA, you're probably going to be somewhere right around $3,250 mark, and conventional going to be right about $3,200. So they're going to be pretty even with each other. Of course, there's going to be a couple of variables in there. Maybe people with not so great of credit scores, the payment might be a little bit higher, but on average, you're going to be floating around that $3,200 price monthly payment.
So, James, of course, thank you for that, and thank you for being on the show. So I wanted to have you on here just because, you know what, we're moving into the summer. I wanted to get a market update from your perspective of kind of what's out there, what's happening, and get your opinion on how everything's going out there. So right now, just basically, what does the market look like right now?
Yeah. So we have been seeing over the past few weeks interest rates on the rise. That's due to the debt ceiling news, everything that was going on with essentially with, the Federal Reserve about to be into default, or the federal government about to be in default. Luckily, Biden on Saturday just signed a bill that's suspending the debt ceiling. So with that being said, I believe we are going to start to see interest rates start to move back down. Essentially, that's going to be a great thing. Once rates start to go back down, that's when it's going to start to get more buyers back in the market. Unfortunately, when this kind of news comes out, people, see it and they get worried and they hold off on buying, or even if they're already in the process of pre-qualification, they might hold off to see what's going on. But as of right now, with that raise in rates, it definitely put a little bit of panic in everybody. But I think right now we're going to start to see rates start to go back down.
Okay. And then do you think we're still in a buyer's market? Are people still getting concessions? Are you still seeing people getting concessions on contracts?
Yeah, as of right now, I do believe we're still in a buyer's market. Majority of the contracts that I'm receiving right now are having concessions, which is great because for a long time, no concessions were given. So buyers are paying their own closing costs, which is a hefty out of pocket. So yes, I am seeing concessions on people from sellers right now. So buyers are really lucking out from that. So I do believe it's a buyer's market. I don't think there's as many buyers out there right now because of where the interest rates are at. So that actually helps out with the buyers that are currently shopping. Less competition out there, gives them more negotiation powers and allows them to, if there's repairs they want in the house, being able to get those kind of repairs taken care of. Whereas prior, sellers weren't fixing anything. They're just saying take the house as is. And then, getting their closing costs paid for, that's a big one. It could save a buyer $7,000 to $10,000, just depending on how much they're going to be able to receive from the seller.
Okay. And then what are some common mistakes that you're seeing right now that some of your clients or potential clients are doing that are hurting them either in the pre-qualification process or once they're already in the home buying process?
Yeah. So I guess some of the best ways I can answer this question is just to go over what we don't want buyers to do during getting pre-qualified or as they're working to get to that process. One of the biggest things is definitely work as many hours as possible. If you're a full-time 40-hour employee, work your 40 hours. Don't take a 30-hour week one time that goes unpaid, or 32 hours, because And most of the time we're going to be averaging your income. So if we're trying to qualify for the most you possibly can, we want to be able to use as much as possible. So work as much as you can, at least work your minimum 40. Try not to take any kind of unpaid vacations. Just make sure you're getting that kind of your hours and your income under getting that to where it needs to be. Cash, you definitely want to make sure that we avoid any kind of cash deposits. An underwriter's going to be looking through it. An underwriter can say, hey, if they see a cash deposit, typically it's going to be based off of how much the cash deposit is, if they're going to care about it or not. But best thing to do is just keep that money, or deposit it, let it at least sit in there for typically 30 to 60 days. Try not to deposit, while in the process or under contract of buying a house. We can always go over ways to maybe put that cash to use if needed, but definitely trying to avoid any kind of just irregular cash deposits. Make sure everything going in your account is typically from your payroll, things like that. Other than that, try not to do a lot of increasing of your debt. Don't take out any new loans, no new auto loans, credit cards, anything that's going to increase your overall debt to income ratio. As well as if you have collections, try not to put them all into like a disputed status. Certain programs like FHA doesn't allow for certain disputed accounts over a specific amount. That kind of stuff can just cause more headache for you as you're trying to purchase a house. So keep everything as is. Let us look at your credit report. And then from there, based off what we see, we can give you the best guidance possible to put you in the best position to be able to qualify.
And then, of course, if they have any questions or they think they want to do something, of course, always run it by you.
Correct. That's the biggest thing I always tell my clients too, is when we're going under contract, if you have any questions about something, you're just unsure about it, reach out to me. The best thing I could do is just go over really if you should do it or if you shouldn't do it. And if it's an absolute must, we'll go possibly what that might look like on your end as a buyer, if it's going to affect how much you're going to qualify for. But definitely run things by me versus just going out there and making a decision and hoping for a good result.
Okay. And then what are some factors that potential home buyers should consider when determining their budget and affordability when it comes to home ownership?
So one of the biggest things that we look at is for a W-2 employee that's going to be hourly, we're going to be basing your pre-qualification off of your gross income. So we actually can use a little bit more money as far as your income, as far as what we can qualify you for. But you as a buyer, you're looking at what your take home is going to be. So when I'm telling you how much you're going to be able to qualify for, and we're looking at that payment, you also want to take a look at what you're actually bringing home, as well as what kind of monthly debts you already currently have in existence. The biggest thing that I want to make sure that when I'm working with my buyers is to make sure that everything fits within budget, because the last thing I want my client to do is end up in a default or be spending every penny they have from their paycheck to pay their mortgage and have very little money to go out and do simple things like go to the movies or go out to eat. Those things are, what you want to do. You want to be able to have that kind of life. You don't want to be dumping all your money in there. So when you're looking at your budget, take a look as far as what you're bringing home, subtract really everything as far as what your monthly debts are and how much you're going to need for groceries and how much you have that amount left over. Whatever that number is that we can use towards a mortgage payment, let's take a look to see where that's going to put you in terms of sales price. That's also going to help you when you're out there looking at homes. So if you're just looking online and you're looking at homes in, say, the $500,000 price range, because that's where all the homes are that are great. But if you need your payment at $2,000 a month, we really need to say, okay, hey, if you need to be at $2,000 a month, you have to shop in this price range to make sure that you can fit your budget and your needs. A lot of people will talk about getting co-signers to qualify for more. And that's great. Co-signers are a great way to be able to qualify for a higher sales price. But when you do that, your monthly mortgage payment at that point is going to go up. So you want to make sure that you're going to have that money to make that mortgage payment, even if you do have a co-signer. Maybe not so much try to rely on the fact that maybe you're going to have a roommate on there to help out or something of that nature. Make sure that you can make that mortgage payment with your own income.
That's awesome. Thank you for that information. So let me ask you this. What can you tell us right now and educate our listeners about the programs that are out there? Because a lot of people believe the myths of, hey, you need 20% down to buy a house, or a lot of people keep on renting because they don't think they can afford to become homeowners when they're already paying a couple $1,000s of someone else's mortgage.
Correct.
On a monthly basis.
A lot of myths about down payment. Just some of the bare minimums. Conventional can qualify you as low as 3% down payment if you're a first-time home buyer. FHA is going to be 3.5% down. VA, which is great if you're a veteran and you qualify for it, you can be 0 down. And then there's USDA home financing, which is homes in rural areas where you qualify for 0 down as well. Other sides of those typical standard products, there's programs out there that's called down payment assistance. Some of the big programs that we offer are programs called Home in 5, Home Plus, and Chinoa. Those are the most common that I typically see. Those programs are great. And of course, their products are going to vary depending on what's going on in the market. But those are going to help cover your down payment and even in some cases cover some of your closing costs. So that's going to be a great way to help keep your out-of-pockets down to a minimum, which would be nice. But again, those products can change and you can't always rely on them. So for an example, over the past few weeks when interest rates have gone up just because the news of the debt ceiling, the down payment assistance programs were still offering products, but they started to take away some of the products that they were offering. So maybe one of them was just offering a conventional option and they weren't offering FHA options. So it just really depends, but there are programs that are out there that are going to be help you to qualify. There's a program out there that has no income limits, which is nice. So no matter how much money that a buyer is going to make, you can qualify for it. Other programs are going to have income limits that they're going to want you to standard to be able to qualify for it. So it's my job as a loan officer to explore every option for you based off of what your needs are. If you're typically best case scenario, as far as terms wise, if you come in with your own money down, you're not going to have the same restrictions that you would if you were to use a down payment assistance program. And in most cases, you're probably going to get a little bit better interest rates. But if you guys have money out there and you're like, I don't want to spend it all towards my down payment or closing costs, and let's look at the possibility of using these programs. Maybe get you into these programs and look to refinance down the road. There's programs that you can get money for free from the down payment assistance program where you don't have to pay it back on a monthly basis. But let's just say if you refinance in 3 years or 30 years, you're going to have to pay back a prorated portion of that money. But as long as you got enough equity in your house, you could just roll that money into the loan when you refinance it. So there's options out there that can really keep people out of pocket with minimum downs. I just did a loan for a buyer whose down payment was completely covered by down payment assistance and closing costs were covered entirely by the seller. So the buyer literally spent $0 out of pocket to purchase the entire house. I think they might have spent like $150 on a home inspection just to make sure that the house was good. But to purchase a house in terms of loan for absolutely $0, they got a full refund of their earnest money deposit too. That's a huge win for a buyer. I know it really helps them, and they know the money that they do have, whether if it's just a month of reserves or 2 months of reserves out there, they can keep that money, use it towards their mortgage payment versus just trying to spend it on closing costs or down payment on a home.
That's awesome. That's awesome that you're able to do that and be able to get in a home instead of having to rent from someone else and paying someone else's mortgage.
Yeah, exactly.
So let me ask you this. When it comes to a second home, because I've been actually looking into some stuff about second homes, what are the rules there on second homes? Does it have to be a certain distance from your primary home?
So it doesn't have to be a specific distance, but an underwriter is definitely going to look into it for you as far as how far the house is. And the reason they're doing that is to make sure that they want to make sure there's no kind of what they say occupancy fraud going on. So let's just say, for example, a second home typically is going to require at least 10% down on a property. And a second home is a property that you're going to be supposed to be living in typically half of the year. So when you're qualifying for that, you're going to be qualifying for your current mortgage or your current rent, and then as well as the mortgage for the next property. We can't use rental income to offset the second home just because that's not going to be an investment. That's supposed to be property that you're going to be living in. So on average, 10% down on those properties. It's going to have to be conventional financing. FHA does not allow for it. So conventional, what would we be looking at to qualify you?
So you wouldn't really be able to, let's say, for example, buy a second home and then use it 6 months of the year and then rent it out 6 months of the year.
You're not supposed to, no. In terms of an underwriter, the purpose of it is not to be an investment. It's a vacation property for you. So the reason why the location does matter too is if you currently own a home in Phoenix, most people aren't going to vacation in Tempe. It's supposed to be a place that you can go live in and share it. So for example, a lot of second homes that I do are going to be in places like Flagstaff, Prescott. So people are going to live here for a portion of the year and then go up like snowbirds and then go live in the other portion of the year upwards and then with the higher country, get away from the heat. But people aren't going to go across town to live there for the other half of the year. But there is instances where I've ran it by an underwriter and it has worked. And it's going to be based off of people's specific situations. I know one situation we had where it was like a custody battle between two parents and he lived in one area, but his kid's school was in another area. So essentially the underwriter was like, yep, it makes sense why he would live in here for a portion of the year and then live in that house the portion of the year. And it's based off of where the buyer is going to work as well. So there are nuances that can work. Everybody's situation is going to be a little bit different. It's just not black and white. So basically, if you tell me what you're looking for, my goal is to always make sure that I'm going to run it by a scenario, make sure that everything is going to work for you. Because the last thing we want to do is put you under contract on a property and then find out for some reason it doesn't work and all of a sudden we have to cancel the contract. That's not what we want to do. I mean, I'm sure that everything is going to be 100% golden when you go under a contract on that new property.
Okay. So is there any other advice or anything else you want our consumers to know while they're shopping in this market right now?
The best thing you can do as far as advice is just to know that, yes, we are in an area right now where interest rates are higher. And unfortunately, the downside of that is it's going to increase your mortgage payment. The benefit, though, or the positives of it is interest rates are going back down, which is nice. I do firmly believe rates are probably going to be floating around the mid 5% range towards the end of the year. Fannie Mae even released an article towards the end of last year, 2022, that they were projecting rates to probably be at 4.5%. I don't think that that's going to be the case. I think probably more around the 5.5% range, but if you get into a mortgage right now, while you can get a good deal on a property, while you possibly get the seller to pay your closing costs, yes, you might have to sacrifice by paying a little bit higher of a mortgage for right now, but maybe if you refinance in 6 months, 9 months, or 12 months, once those rates drop, you could be able to really get that mortgage payment down, maybe a few $100s, and at that time, that's when that mortgage payment will be really more within your budget. So you might sacrifice by having a slightly higher mortgage payment just for the time being, but knowing that there is going to be a time when we're going to be able to refinance you. I'm going to call you right off the bat, say, hey, rates are down. Let's go ahead and look at numbers and get that payment down to where you want it to be.
Okay. So, James, if someone were to want to reach out to you to start the conversation, ask you questions, or see what they pre-qualify for, where can they reach out to you?
Email and cell phone, and of course, social media. Those are going to be the big ones. My cell phone is always with me all the time. So if you're going to reach out to me, I'm going to respond to you right away. For any reason I'm in the middle of something, I'll get back to you as soon as I possibly can. Or if it's really late at night, I'm available. I'll definitely get back to you. Or if you want to just shoot me an email, james.serrano@fairwaymc.com. It's another option. Or social media, Instagram, 623Jimmy. So feel free to reach out to me anytime. Those would be the ways you can contact.
And what's the phone number for them to call you?
Phone number is 623-204-8453.
Okay.
Arizona native.
There you go. So if you guys have any other questions for Jimmy, of course, reach out to us on our socials, or any insurance questions or any insurance needs. Of course, always reach out to us. But James, thank you for being on the show today.
Thank you so much. I appreciate you having me.